Imagine you have $1,000 and put it all into Broadcom. In 10 years, will it turn into 10,000 or flatline? Our study shows the max potential is just 0.3x. We're going straight to the 10K to find out the problem. One day, one stock. Today, we'll look into Broadcom. Welcome to Stock Snack. All kind of financial numbers could be overwhelming. At Stock Snack, we help to analyze stock, if they are good or bad. At Stock Snack, we help justify it and present it to you. Fast and joy, like having snack. Subscribe now to find the simple truth in complex reports. Okay, today we are breaking things down, just into 4 simple parts. First up, qualitative analysis. We just need the basics. Who is this company? What are they selling? Who buys it? And who are their main rivals? We need the context. Segment 2. Then we move to the business segments. We look at the revenue. What is their main moneymaker? Which part is growing the fastest? We find the true engine of the business. Segment 3. Third, we get the financial checklist. We look at the books. Is the company actually healthy? Do they have too much debt? Can they afford to grow? It's all about the financial safety. Segment 4. Finally, the price projection. We take all that data and we ask one big question. Is the stock a bargain right now? Or is it way too expensive? That is the entire plan. Simple, clear. Let's start. Let's start with the basics. The company is Broadcom. They are a giant in the technology sector. They sell 2 main things. First, semiconductors, chips. Second, infrastructure software. The whole business is centered on high-end B2B sales. They sell those chips and software solutions. 2 huge companies, data centers, networking giants. That's their whole focus. You see, the name Broadcom is kind of complicated. The roots go back to Palo Alto, California, in 1961. But the modern story starts a little later. The key dates show their hunger. In 2016, the major shift happened. AVGO acquired the original Broadcom. They took the better name, Broadcom. Then came the acquisitions. The strategy was clear. They bought CA Technologies in 2018 that pushed them hard into enterprise software. Then Symantec security business in 2019, more B2B software, more margins. The biggest move, VMware in 2023 for $69 billion. That acquisition changed everything. It massively expanded their software power. So, what makes them money right now? The 2 biggest streams. Number 1 is semiconductor solutions. That's $30 billion in annual revenue. It's the backbone. Number 2 is infrastructure software. That brought in $21.5 billion last year. This is where VMware now lives. And pay attention to a subcategory. AI-driven revenue. That's custom AI chips. That alone is over $12 billion. It's the future growth engine. So, that's who Broadcom is. A Silicon Valley company built by acquisitions. A dual powerhouse in chips and enterprise software. A pure B2B player. Now, let's see why they have such a strong edge. Now, let's talk about the competition. It gets complicated here. Broadcom is in 2 distinct markets. First, the big tech giants, the ones with enormous revenue. Think Amazon and Microsoft. They have hundreds of billions in sales. They own the cloud, like AWS and Azure. They compete with Broadcom software. But then, the direct rivals, the ones who fight for chip and enterprise dominance. These are the most important. Look at NVIDIA. They're focused on AI chips, GPUs. They are a massive rival in the data center. Sales around $165 billion. They battle Broadcom in data center processors. Over $53 billion in revenue. And don't forget Cisco Systems. They are the networking hardware specialists. They directly compete for routers and enterprise networks. Sales are over $50 billion. Then we have Qualcomm. They own the mobile space. They fight Broadcom on wireless components. Those Snapdragon chips are everywhere. And finally, IBM. They are a software powerhouse now. Their hybrid cloud and mainframe software directly clashes with Broadcom's post-VMware strategy. So, Broadcom isn't fighting one enemy. They are fighting every major player. It's a massive 2-front war. Next, let's look at the Broadcom strategy. It is extremely clear. The key word is AI. Their current business frontier is all about it. They are leading the build-out. They sell custom AI, silicon. They build the full-stack private cloud. This is called VMware Cloud Foundation. So, what is their big edge? It's the switching costs. They are incredibly high. Once a large company buys their custom AI chip or locks into that enterprise software from VMware, it is very hard to leave. That gives them power. This leads us to the industry trend. The whole market is moving. They are driving enterprises to high-margin subscriptions. Moving away from old perpetual licenses, it's an aggressive pivot. And the future direction? It's simply more of the same. Aggressive expansion in custom AI chips, shifting even more enterprise cloud workloads, all into those profitable VMware subscriptions. It is a focused, ruthless strategy. But let's be honest about management. The feedback is highly polarizing. Wall Street loves their focus. They generate massive shareholder value. But customers and employees, they often criticize the ruthless cost-cutting and the aggressive pricing. It's a high-stakes, high-reward approach. Now, let's see if the numbers prove the strategy is working. Let's look at the financial segment breakdown. This shows the business transformation. First, the semiconductor solutions. This is the traditional chip business. In 2018, it pulled in about $18.3 billion. By 2024, that was over $30.9 billion. That's an 11% growth rate. Very solid. But the real change is its importance. It used to be 86% of Broadcom sales. Now it's only 56.6%, a massive drop in share. So, where did the money go? To infrastructure software. This is the dramatic story. In 2018, software was just $2.8 billion in sales. Now it's exploded. It is over $23.6 billion. That's a 52.6% compound annual growth rate. Huge. This segment's share jumped from under 14% of the company to over 43% now. This move was the whole point of buying VMware. It totally rebalanced the business. And there is a tiny bit of intellectual property licensing. It's just 0.2% of the total. It's not the focus. The takeaway is clear. Broadcom is no longer just a chip company. It's a powerful hardware and software giant. They made a huge strategic pivot, and the growth proves it worked. Now, the price projection. This is the big question. Is Broadcom a bargain right now? We look 10 years out. Our benchmark, the S&P 500 ETF, that usually returns about 3 times your money. $1,000 becomes over $3,000. Broadcom's own intrinsic valuation. It shows a mixed bag. The Cashflow method. It suggests a loss of money over 10 years. $1,000 might lose $131. A negative return. But the EBITDA growth, this is a more aggressive view. It suggests a gain of 0.9 times your investment. So $1,000 gains about $890. The average projection, it's much lower. It shows a gain of just 0.3 times. $1,000 gains about $338. You see the big problem. To even match the general S&P 500 average return, the current stock price needed to be much lower, like half the price it is today. Right now, the stock is priced for a premium. It expects that massive AI growth. It expects that huge VMware subscription pivot. It's priced for perfection. Do you think it's valid? Comment your thought below. Now we get into the core health of the business, the real numbers, the audit. We've gone through 3 main statements in the annual reports, namely the balance sheet, the income statement, and the cash flow statement. Each, we analyze multiple metrics to access if it is healthy. This will be discussed later. Right now, we will provide an overview to get a top-line insight first. So, let's see how Broadcom scored. Starting with the balance sheet, the short-term snapshot. It scored just 33% good. That is a bad score. Too many immediate red flags there. Next, the income statement. How profitable are they? They scored 62.5% good. A C-, basically. That is also technically bad for a tech giant. The best part? The cash flow statement. Money in, money out. They scored 50% good. That's a bad score. Cash flow is not doing okay, but the real story comes from the key attributes, the big picture growth drivers. Revenue growth, good score. EBITDA growth, good score. Strong free cash flow, good score. And their debt is manageable, good score. 4 out of 5 key growth attributes are good. The only one that fails, the last one, whether the stock is well priced, that is a very big bad score. So, financially, they are strong and profitable, but the valuation is severely stretched. A mixed result. Okay, let's drill into the balance sheet. We are looking for financial discipline here, the bedrock. First up, cash to debt. We want them to hold more cash than debt. The benchmark is over 1. Broadcom's score now, 0.28. That's bad, very bad. It means their cash on hand is far less than their debt. Second, debt to equity. This shows how much they fund with debt versus shareholder money. The rule of thumb is under 80%. Broadcom is at 100% now. It's bad. They rely too much on borrowing. Look at the 10-year average. It's even higher. Third, preferred stock. This is easy. We want 0. Broadcom has 0. Good score. It means they don't need complex funding. Fourth, retained earnings, CAGR. How well do they consistently build wealth? The 2024 number is minus 100%. That S, a definite red flag. Bad score. It shows instability in capital retention. Fifth, treasury stock. This tracks share buybacks. It shows if management is actively returning value. Their score is 0. Bad score. They are not effectively managing the share count. Sixth, return on equity row. This is a key efficiency metric. We want this over 25%. The average is just 23%. Bad score. They are not generating enough profit from shareholder equity. Finally, return on total assets ROTA. How well do they use everything they own? The average is a great 34%. This is a strong, good score. It tells you one thing. They are highly effective with the assets they buy. They just carry too much debt. Next up is the income statement. This shows their real operational strength. First, gross profit to revenue. This tells you their pricing power. The benchmark is over 40%. Broadcom's 2024 score is 63%. Good, their chips and software command a premium. Second, SG&A to gross profit. This is their sales efficiency. The benchmark is under 30%. Broadcom is at just 15%. Good, the product basically sells itself to those big B2B clients. Third, R&D to gross profit. Are they spending wisely in the future? Again, the benchmark is under 30%. Broadcom is at 29%. Good, they are investing heavily in AI and innovation, but they keep it disciplined. Now, the red flags begin. Look at interest expense to operating income. This shows debt cost. The benchmark is under 15%. Broadcom is at 29%. Bad. Their mountain of debt from those massive acquisitions hurts here. Fifth, income tax to pre-tax income. The benchmark is around 20%. Broadcom's is 39%. Bad. They pay high corporate taxes. Sixth, net income to revenue. The net margin, the ultimate profitability. We want this over 20%. The average is a very strong 23%. Good. But the most recent, 2024 number, is only 11%. Bad. This suggests a recent dip in overall profitability. Seventh, net income per share, CAGR, is the shareholder wealth consistently growing. Their 10-year growth is 11%. Good shareholders are getting steady returns. Finally, debt to EBITDA. This is the big debt metric. It shows the payback period. The benchmark is below 3. Broadcom's 2024 score is 2.86. Good. They are managing that huge debt load. So, operationally, they are elite. But high debt and high taxes are trimming the profits. They are profitable, but paying a premium to be so big. All right, last section. The cash flow statement. This is arguably the most important. It shows how clean the company's earnings really are. First, stock-based compensation to revenue. This tells us if management is overly diluting shareholders. The benchmark is typically under 10%. Broadcom is at 11.1%. That's slightly over, but the 10-year average is 7.3%. We will call this good. For now, they aren't wildly diluting. Second, operating cash flow versus net income. We want operating cash flow to be greater than net income. Cash earnings should equal book earnings. Broadcom's score is 0.3. Bad cash flow is much lower than the reported profit. Third, free cash flow growth versus net income growth. We look at the difference in their growth rates. We don't want cash flow to fall behind. The net income CAGR is slower than the free cash flow CAGR. The ratio is 1.7. Bad, it shows high cash outflows. Their reported earnings are growing faster than the cash they actually keep. Fourth, CAPEX versus net income. Are they spending too much to stay alive? The benchmark is under 25%. Broadcom's CAPEX is tiny, 9.3% now, 7.8% on average. Excellent score. It means they don't need huge spending to maintain the business. This is a core strength. Fifth, total payouts versus free cash flow FCF. This is the big one. It checks if they use money for growth instead of shareholders. The benchmark is under 100%. In 2024, they paid out 113.4% of FCF bad. They spent more on shareholders than they generated that year, but the 10-year average is 84.9%. Good. Historically, they maintain discipline. So, the cash generated is absolutely massive. But in the short term, they spent more than they earned. That debt and tax load is clearly an ongoing weight. What do you think? Comment your thought below. So, here is the full picture for Broadcom. The business model? Excellent. They made a successful strategic pivot from pure chips to a software and AI giant. Their competitive advantage is real. High switching costs for those enterprise clients. The financial health check. It's bad. All three statements failed the latest tests. The balance sheet is weak. Too much debt. The cash flow shows low quality of earnings. But the key growth attributes, they are good. Revenue is soaring. EBITDA is massive. Debt is under control. Now the crucial part, valuation. The average price model shows a maximum 0.3 times return. That is far below the S&P 500's expectation. The stock is already priced for that perfect growth. This doesn't mean good or bad for the stock. It's just an analysis. Different person have different opinion and risk behavior. So, the company is elite. The price? Expensive. Comment below to let us know what you want to deep dive for next.